Let me start by saying that I think the notion of an economy itself is a bit subject to interpretation, right? Especially for people like me who are in public service. The benchmark of what we want to achieve in terms of economic development needs to be fairly well defined. There can be many different interpretations. Also, let me just make a disclaimer here that if I say something, I'm not necessarily implying it is the policy either of the government of Tamil Nadu or of my party, but rather just my understanding of the theory, the fundamentals, my experience in the world, and then my vision for why I came to public life and what I think are the important things. So let me first start by saying that when you look at the economy, the primary question is, are we looking at a gross number, like what is the GDP of the country? Are we looking at a per capita number divided by citizens? For example, I was recently in Western Australia. Western Australia, the state of Western Australia, has roughly the same size economy as the state of Tamil Nadu, about 300 billion US dollars. But in Tamil Nadu, we have between 75 and 80 million people, we think, because we haven't had a census since 2011. But Western Australia has a population of about 2.6, 2.7 million people. So we really have a profoundly different quality of life per capita economy. And so sometimes when we talk of targets like 5 trillion, we are maybe, it's easy to communicate, but we are not really focusing on what I would consider to be the very important variable, which is per citizen, how is our economy? There's a second way that I would say we should think about this. The gross economy is, a good indicator, but a much more important indicator, more even than the gross economy to me, would be what we call the Gini coefficient, or it's a measure of how unequal or how disparate the outcomes within a society are. And you can look around India, you find great variances in the Gini coefficient, great variances in the disparity. A Gini coefficient is a bit amorphous to measure, and many different people will have different calculations of it, because the raw data that goes in is not that high quality in India, or at least uniformly across all states. But just to give you a contrast, if the Indian average Gini coefficient is about 44, 45%, or 0.44 out of 1, and the higher the number is, the greater the disparity. The lower the number, the more equal the society. In Scandinavian countries or in some welfare states, that number will be, sub 20% or 25%. In, some developing countries, it will be 50, 60%, where there are a few really wealthy people and a lot of poor people. But if you look at it across India, you'll find two types of differences. If we compare Maharashtra, which is a relatively rich state, and Tamil Nadu, which is also a relatively rich state, already you can see a big difference. Tamil Nadu's Gini coefficient around 35%, Maharashtra is around 45%. So there's actually much greater disparity in Maharashtra than there is in Tamil Nadu. But that's both rich states. Now you can go to relatively poor states like Bihar and Chhattisgarh, and there you'll find great disparity as well. Bihar has a relatively low Gini coefficient, about 31, 32%, or that order, and then Chhattisgarh has something like 47, 48%. So poor, rich is one dimension, not orthogonal but not clearly correlated dimension is it an equal or an unequal society? And then, of course, you have other measures of progress far beyond a quantitative number: access to healthcare, access to sanitation, access to good housing, good education. And there, measures like social development index or human development index, again, to someone like me, those are very important measures. The point of progress is that it should be inclusive, it should be widely distributed, it should have opportunities for all rather than for few. So really, the quality of an economy is more important, in my opinion, than the quantitative number of what is the GDP or what is the size of the economy. Then let me put another perspective. Economies can be large or successful, or country level economies, on multiple dimensions. For example, there are states that produce so much oil that they just make money out of selling the oil. There's not really productivity or high level of education. They just are able to make a lot of wealth selling the oil and then distribute that. And then there are, different versions of that also. There's a Saudi Arabia, which is one kind of oil country, and then there's a Norway, which is a completely different kind of oil country in terms of its social construct and the framework in which democracy or the form of government works. Then you have other countries that can leverage either location or membership or legislation. So if you take, for example, Singapore, Singapore is a very tiny country, even relative to Malaysia that it's split out of. But Singapore's economy is really large, mostly because it serves as an entrepot where both trade as well as capital move in and out of Singapore far, far in excess to the population of Singapore. Then you have Ireland, where a lot of intellectual property resides because of the unique positioning of Ireland, on the one hand within the EU, on the other hand with some very what can I say, flexible and very accommodative tax strategies. So even tech giants like Google, Microsoft, etc., you'll find that their intellectual property is held out of Ireland for tax advantages, and it inflates the scale of the economy. So you can have economies that succeed on different dimensions. But in the extent that we are a global economy even now, even after all the anti-globalization and the fragmentation that is happening in the last decade, the protests against globalization. In fact, we are still a much more integrated economy globally than we were, let's say, 20 years ago. And if it continues in that kind of direction, then the surest, easiest, clearest way to compete is through having high per capita productivity in the workforce. Now that can come through education, it can come through skill training, it can come through finding niches and specializing in those. But the most reliable, independent of external variables like were you blessed with oil or coal or iron ore, or do you have almost an arbitrage in terms of your location or tax or customs or other policies, is to have high per capita productivity. And in that sense, I just want to say that there are many different approaches to arrive at that goal. And I'll talk about a couple of them in a minute. But let me now just give you one other thing to think about when we talk about economies, and that is the effect of time, and what we would otherwise call in finance the effect of compounding. That is, if you go back, let's say, to 1990. In 1990, China and India had roughly the same per capita income. That was, per person in purchasing power parity terms, in dollar terms, we were roughly the same. In fact, India was slightly better than China. Now, fast forward 30 years, despite our liberalization, despite our reforms, despite us breaking out of this notion of the Hindu rate of growth, we would find that China is 3 times or 4 times, depending on how reliable the statistics are, much better off than us, between 3 and 5 times per capita, adjusted for the population. So, if you look back and try to extrapolate what should have been the difference, let's say India was growing at an average of 6% and China was growing at an average of 11%, 1.11 to the power of 30 yields you that much greater outcomes than 1.06 to the power of 30. So the time value, the compounding value of doing things right for a long period of time accrue quite aggressively. And in the case of China, they did it mostly through capital formation and keeping the wages relatively low. So if you say the Chinese economy has seriously tripled or quadrupled, then not all those benefits have flown to the factory of the world, the workers who are working in the greatest jump in production in the history of the world. So these are all nuances and aspects of economic development that we should think about when we talk about the economy. Just bandying about numbers is not really meaningful. In fact, I'll go aside here. Every now and then we get these statements about this month we had the highest ever tax collections, therefore it means something is going well. The GST regime is succeeding. But in fact, numbers always increase, barring exceptional circumstances. Economic numbers every year will only go in one direction. And they'll only go in one direction because of two things. One, for most countries, the population is increasing. Therefore, even if the per capita number stays the same, the scale of the economy will keep increasing because more people are engaged in economic activity. The second reason the number will keep increasing is that we report most numbers in layman's terms in what we measure on the street today, which we call nominal. And nominal includes the effects of inflation, and money is constantly weakening. So again, barring very extreme examples or rare examples, deflation is not common. Inflation is much more common. So numbers keep going up all the time. That's the nature of scale. And the fact that every month we get some chest thumping that says the number is better than last month is meaningless. For it to be meaningful, we should ask the question, is this number adjusted for inflation greater than it was last time? Or is this number adjusted for the population greater than last time? Which means we should look at per capita numbers rather than gross numbers. Now, having put all of that as the framework, let me get to the actual topic at hand, the future of the Indian economy. India is such a disparate country that it's hard for me to predict or talk about one common economic trajectory for the entire country. Just to give you some context in that, at independence, there was probably no state that was more than twice as good as any other state or half as good as any other state on any measure of economic or human development or social development. That condition lasted largely unchanged till the reforms of 1990. The best state was probably 2.5 times better than the worst state, whichever measure you took. What the reforms did, what they always do, what free trade always does, it greatly accelerates the overall growth, the overall global economy, or in the case of India, the overall rate of growth. What it cannot do, unless somebody purposely thinks about these things, is ensure equality in the distribution of that acceleration. In fact, it's almost guaranteed that if you have that kind of rapid acceleration, it will lead to increased inequality. Some will benefit much more than others. And that's true of international trade, that's true of Indian liberalization. So if you look now, let's say the state of Haryana is, 5 times the per capita income of the poorest state. Or if you take Tamil Nadu, is 4 times the per capita income of Bihar. That was not true in 1989. So reforms provide opportunity, but some places have the prerequisites to benefit from reform. As I said earlier, the greatest prerequisite is to have an educated, English-speaking, globally connectable workforce. And if you have that, that greatly accelerates your outcome. I'd also say that there are at least two profoundly different approaches to economic development visible in India today. The one that states like Kerala, Tamil Nadu, and many of the southern states adopt is a people-centric approach. We believe that if we increase the nutrition, the access to education, the access to clean drinking water, we will find that our children grow up better equipped to deal with the global economy, to compete, and that we will get greater benefits in the long term. So our spending tends to skew towards social sector and uplift of the human condition. And then you have the government at the Union of India today, which clearly between 2014 as now has greatly reduced its spending on the social sector and greatly ramped it up on infrastructure and kind of building the framework. So it's what we would call a supply side model of economics, where they believe that if they build the infrastructure, they have the factories, that there will be automatically investors and jobs, and then jobs will provide incentive for people to get better skilled. So it's kind of from the demand side, or from the supply side, or from the human side, or from the infrastructure side. The problem is none of these is perfect. If you take the kind of people-centric social spending model of places like Tamil Nadu or Kerala, while it produces many advantages, it also is prone to being hijacked by the few, the elite, the percentage of the economy or the budget or the spending of the government that goes to the hands of very few people can easily be diverted. And if you look at what percentage of Tamil Nadu's budget goes to wages and pensions for government servants, or for that matter, Kerala, which is probably worse, you see that you have very little room left to do all the other programs that you want to do. On the other hand, if you go to an infrastructure supply side kind of model, it is a corollary that you're going to end up with some form of crony capitalism. You're going to start trying to create national champions, as has been happening since 2014, with a couple of the big Gujarati names. You know who I'm talking about. And sometimes if these people turn out to have lead feet, now you're going to have serious structural impact to your economy because you put too many eggs in one basket. And there's also the notion that sometimes if you build it, it's not necessary that they will come. For example, somebody tells me that there's this massive highway from Agra to Kanpur or something, or Lucknow, which is like, 8 or 10 lanes, but it's probably built to a capacity that the next 20 years of traffic will not actually benefit from that big a road. So, was it done more for showcase? Was it done for extraneous considerations? So it's a delicate balance. There's no 100% perfect model, but there are clearly different models. And as long as elected governments get elected based on their true philosophy that they're going to implement, then the people can't complain. I say I'm for X, I get elected, I do X. Somebody else says they're for Y, they get elected, they do Y. That's what the people voted for. Where you have a problem is people who intend to do Y, claiming that they're for X, and if they can run a propaganda machine that basically makes it look like they're for X when they're really for Y, then you have a bit of a problem, and we're seeing that right now. Let me now turn to a broader global perspective. Right now, we are living in a very unique global economic environment. For those of you who have studied much of this or followed it closely, starting with the 1990 Nikkei crash in Japan, the notion of monetary policy, that is, how much central banks can actually stimulate or control the economy through interest rate movements, that notion has been under stress. And in fact, the phrase quantitative easing, which was basically um, in modern times deployed in Japan for the first time when they found that after taking interest rates to zero, they still couldn't stimulate the economy, so they had to do something dramatic. That notion has now spread around the world. After the 2007-8 crisis, every major economy, every OECD country, the European Central Bank, all of them have been doing some form of quantitative easing. And in some ways, the notion of quantitative easing is itself kind of the obituary of traditional monetary policy. Because if you need to resort to quantitative easing, you're only proving the adage that you cannot push on a string. And when you do quantitative easing, as many critics rightly point out, what are you achieving if your intent under normal monetary policy is to stimulate the economy through making money cheaply available? Then I would say the last 10, 15 years of global policy after the crisis, global monetary policy of many OECD central banks, and Japan going back to 2000 or 2001 have been utter failures. All this money was not able to stimulate growth. What it did was prop up asset prices. It kept the stock markets high, it kept the bond markets protected, it drove up real estate, it drove up art, gold, and a lot of the money ended up in different places than the origin. So if you look after the 2007-8 crisis, in the 5 years after that, OECD banks printed about $4 trillion, $4,000 billion of excess liquidity by buying long-term bonds and throwing cash into the market. About 3 trillion of that ended up in the emerging markets. It ended up in Africa, Asia, the Middle East, and it ended up doing some good, but a lot of strange things to our economies in terms of valuation of our shares, our assets, our housing. And it certainly did not do anything for the economies of the US or the UK, which did not see any real boost from this. That was bad enough. COVID changed everything because during COVID, there was unprecedented both fiscal policy easing. Governments were printing money and sending it to people almost without asking questions. And there was a second bout of monetary policy easing. The combined effect of all of that is for the first time, since the money has actually reached the hands of the people who can spend it, that is, the fiscal easing actually put money into the hands of every citizen, as opposed to monetary easing or QE only kept it in the hands of the rich. So you did not see inflation through all those years of QE. Now you're seeing real inflation because fiscal easing has put money into the hands of people who actually spend it, and now you have not been able to keep the production or the supply chain producing as fast as the new spending power. So all of this together is why most people say there's a reasonable risk that we will have a global recession in the next year or so. And in some countries like the UK, there's already a recession because you have this problem of high inflation and already loose monetary policy or already loose fiscal policy. Therefore, no tools left really to control it. And the classic or the stark example of how monetary policy is unable to control easy money is that after almost 4 or 4.5 percentage points of interest rate raises on the front end, which is the only place the Federal Reserve Bank of the United States can control, you now have this phenomenon of an inverted yield curve. And what does the inverted yield curve mean? It means that to borrow 1-year money, the interest rate is 4.6%, and to borrow 30-year money, the interest rate is still only about 3.5%. That's completely upside down. Under normal circumstances, the longer you borrow money for, the greater the interest rate should be because you're locking in uncertainty for a greater amount of time. So all of that together, without getting too technical, I would say the global economy, by most considerations, is facing a headwind. What does that mean for India? Actually, not as much as we would think in terms of negatives, and potentially some positive. Because as you see, for the first time in decades, the tech industry start to do layoffs, and people who have otherwise never had to worry about, a horizon of unlimited growth, now they have had to ask questions about, do we do it more cost effectively elsewhere? Can we find better models of generating these outcomes? And so, in some sense, India is actually in a reasonable spot to benefit from a global downturn, assuming it's not a crash, assuming it's just a downturn, then though we will be somewhat affected because of the global variables, my own view that we will have significant upside in being able to competitively position India and Indian talent and Indian businesses relative to the global cost and supply. There's also a massive de-risking of China going on that was already clear before pandemic, and after pandemic there is a significant global effort from iPhone makers like Apple to textile companies to hardware manufacturers. Everybody wants to not have 100% of their supply chain and their big manufacturing located in China. It becomes a kind of a unmanageable risk because policy decisions of one country can disrupt the entire industry or the entire company. So there's huge potential for India in general, and I would say places like Tamil Nadu, Kerala, if we have the right policies, and I'll come to what those should be. There's also massive de-risking of Hong Kong going on because of the Hong Kong-China contagion. A lot of the financial services companies and the platforms are moving out of Hong Kong. And I think there also India has a significant opportunity to greatly step up its engagement in global finance through that. I would say the last very positive factor for us is the global move towards renewable energy and focusing on climate change mitigation. India in general is blessed with a lot of land, a lot of sun. In many places of India, like Tamil Nadu, a lot of wind, offshore wind, and there's very high scope for India to trade carbon credits as well if we do our model right. So I think these are all global positives for India, with, of course, the caveat that were the global recession to be a massive kind of downturn, then that will damage everybody, including us. Now let me talk about policies of the union government and policies of the state governments, and then probably close with that. I worry that a lot of the policies of the union government are driven more by political considerations rather than kind of economic ones. From promoting Gift City as the only financial services center in India almost exclusively, to using their hand to or thumb on the scale to twist investment into Gujarat, to framing the PLI incentives in such a way that it benefits certain industrialists and certain states. In many ways, a lot of the policies reek of crony capitalism. Now, this is not an accusation that needs to be argued. Outcomes show it's right or wrong. If you look at the concentration of assets in the hands of people, if that has increased a lot, like, let's say a lot of ports, a lot of airports in one hand or one corporate hand, then my concerns about crony capitalism are validated by such outcomes. There's also the question of India's demographic dividend. We have a lot of youth. We are one of the youngest average age countries in the world. Is this a plus? Certainly. If we can get the ratio of people working to those being supported in retirement or pensions right, then it's a great plus. But if we have high levels of unemployment, and some data suggests it may be as high as 30% in the youth, then it could also turn out to be a very, very dangerous social situation. As you know, a lot of unemployed or underemployed or disgruntled youth is the basis for evolution in most of the history of mankind. So, that's something that worries me. And I must say, in fairness, that I have a view that there's a window of opportunity with all these global tides moving our way, that we should really be accelerating now to deploy the demographic dividend, keep all of them gainfully engaged, and get a decade or two of China type growth, what China experienced, let's say, between 90 and 2010. There's another view, which my erudite friend, the Finance Secretary of India, Mr. T.V. Somnathan, he gave a speech in Chennai about 3 or 4 months ago, and he pointed out to many examples where he said, actually, it's not like this is the only window of opportunity. There are many ways for companies or countries to grow rich, and sometimes you can just grow at an average rate of 5% a year for 20 years, and that's good enough. You don't have to grow at 10% a year for 10 years. You can still arrive at a fairly decent outcome, and he pointed out to many things in history. I have my own disagreements with it, but that's a plausible argument that you should consider, that maybe my view of urgency is not really justified. The last thing I would say is that we are a capital short country. That is, we don't have enough investment capital, and we don't have reasonable likelihood of generating as much as we need if we want to have the kind of growth that we would like to see. China is a command and control economy. They were able to direct it that way. In India, our capital formation has actually been declining for 7 or 8 years. Therefore, we need international capital. And there's so many places that are looking to invest, right? The wealth of the world has kept on increasing, always increases unless there's a global recession. And many of the countries where this money is are countries with small and declining populations that have huge pension obligations coming up. Countries like Japan, like Australia, like Canada. So there's a lot of money looking for homes in the kind of investments that we want. Infrastructure investments, education, long-term ports, airports, roads, these kinds of things. So the question then is, what is it that we should do to attract that kind of investment that is desperately looking for places to get return on a more actuarial, steady state, bond-like return? And I would say the policies of the union government determine many, many things. And the extent to which they take advantage of this kind of inflection point, where there's great volatility in the global economy, to the extent that they do what I would say most investors in the world expect. Before an investor puts money into a project, especially if they are the kind of actuarial long-term 20, 30-year return projects that I'm talking about, the conditions they're looking for, they want a peaceful society. They want harmony. They don't want violence. They don't want disruption. They want predictability. They want continuity of policy. They want the rule of law. They want that it should not be one man can suddenly change his mind overnight and the law of the land can change. That's what reasonable people would want if they were going to invest money for a 10 or 20-year horizon, let alone for 1 or 2-year horizon. And therefore, I would say it behooves the union government to try and make these the conditions of the land, rather than strife, rather than conflict, rather than radicalization, to provide a harmonious, calm, stable, social environment, the rule of law, and adherence to the Constitution with strong, independent institutions and a judiciary that can act in a timely and conflict-free manner. At the state level, we should really be doing a few things ourselves. One is focusing on skilling our workforce to the demands of the global economy, on improving the ease of doing business. I was just talking to our host here, and he was saying how difficult it is sometimes to get clearances and permissions and get a project executed. Nobody wants to come and put their money and wait for 5 years. So the more transparent, the more predictable we make our processes, so that an investor can come today and get their business up and running in the shortest time possible, then we are doing ourselves a favor and going to be able to provide jobs and see growth. And finally, I would say, at least for states like Kerala and Tamil Nadu, we should really build and leverage relationships because of our high education levels, because of the diaspora that we have, who have gone to all parts of the world, succeeded tremendously in many fields, are the tycoons of industry, are leaders in their professions. We really need to build relationships with these people who must have, and in my experience, who universally have some buttress, some affection, some remaining love and affection for their land, their people, then to leverage those relationships, among others, and to try and attract global investment, foreign multinational companies to come to India and see India as first a base of operations and then eventually a market and then a place for export. So if you look at, for example, one of our greatest success stories in Chennai is the Korean motor company Hyundai. Hyundai now makes more cars in Tamil Nadu than it does almost anywhere else in the world, with the exception of Korea itself. And a lot of that gets exported. So we actually have a company that brings its technology, its people, its capital, builds in Tamil Nadu, exports it to other parts of the world. We get benefits coming and going.